Hi, everyone, and thank you for joining me. It's Darren Coleman, and we're back with another Coleman Wealth Home Edition. And in my process of interviewing some of the people that I've met that I know that I think are innovators and interesting people from different sides of the wealth management business, today I'm delighted to be joined by my very old friend, Raj Lala, who's the chairman, CEO, and founder of Evolve ETFs. Raj, thanks for joining me. I'm so glad you shaved for this. Thank you so
Thanks,
much,
Darren.
my friend.
Yes, it's my work from home look.
Yeah, well, I know you've been comfortably sequestered outside of Toronto, because I know you and your family want to stay safe, and you've got kids, and you're being very responsible in how you're attending to all these things. So how's it going, by the way, with you and the family, kind of making sure everybody's staying 60 feet from everybody or 60 miles from everybody, in your case, maybe?
Yes, we are practicing social distancing from each other. They're right now. My family's up at the cottage, so I'm home. It's kind of a nice break to have. Probably they're probably happier about it than I am. But it's going well. I mean, you got to try and look at some of the positives from this situation, and it's definitely enabled me, especially as I run my own business, to do things that I haven't been doing very often in the past, which is having dinner with my family every night,
Right.
and even trying to have lunch together. And so we're spending a lot more time together. So it's been great. As you know, I've got a couple of young daughters. So it's been great to spend more time with them during all of this. I think that I think everyone's getting a little bit cagey right now, trying to see when this world is going to reopen so that they can go back to some level of normalcy. But there's been some positives out of this too.
Yeah, and I hope people do take some of those positive things and make sure those are the things that stick, not necessarily the fear and the panic. And but you and I were just talking about how you had a visit to your office downtown the other day. I've been sneaking into mine, and we're seeing these stickers on the floors of the elevators. You got to stand here, and you got to line up over there. We'll see. I mean, everything's going to look like I'm going to the airport pretty soon, right? We'll
Yeah,
see how many
or
of these things stick
as
or not.
as I said, I mean, with the lineups that you're going to have, it's almost like going to be at being at Canada's Wonderland, waiting for your turn to get up there. So, I mean, I think that that's one of the biggest challenges we're going to have in a lot of these high-rise buildings is how long it's going to take to get up and how comfortable you are being in that elevator with three other people as well. So definitely a
That's
whole
right.
new world. And there's going to be some challenges that we're going to have to go through, which is why I think a lot of people are going to continue to work from home.
Yeah, and I know we're gonna talk a little bit about some of the investment implications of those things in a sec. But before we get into the lineup that you've created at Evolve, which is very interesting, and I want to get into why you picked the niches that you picked, because I think this is really cool to get into. But you, to me, and I'm going to say some stuff now on video that's going to kill me as your friend to say, that I've always, because you and I know each other for like 20 something years, so this is this
Yeah.
is killing me to say this, right? That you've always been to me one of the best innovators, not just on Bay Street, but period. You've always been a guy looking ahead at what's coming. And not only what's impressed me about you, buddy, is that you've actually been able to execute. Like a lot of people see stuff coming, but they don't do anything with it. You've always been someone that executes and executes very, very well. So maybe take us through some of the highlights, if you don't mind, the stuff that you've done, because I know you and I met when we were dealing with alternative investments and hedge funds 20 years ago. I know they're getting to be in vogue now, but like you and I are the grandparents of some of these things. So maybe give
Oh
just a little
boy,
history of you guys.
grandparents. That's tough, Darren. Yeah, yeah.
I
You and
see
I
the
have known
gray.
each
I
other
see the
for
gray in your beard, right? So I can make that
yeah,
joke.
it's fake. Yeah, you and I have been friends for 20 years, and to look at it from your perspective and reciprocate, I've always found you to be one of the best advisors out there. Taking a lot of time with clients and getting up to speed on all the products and different strategies and financial planning tips for clients. So well done.
Thank you.
I've been really happy to watch how you've grown your practice over the last 20 years.
Thank you very much. Okay, enough about
Yeah,
me.
yeah.
Back to you. So you built a hedge fund 20 years ago when it was brand new. Um, you went to Jovian Capital. You were a big shot at Fiera Investments for a
Mhm.
while. Why am I giving you your history? You give me your history. Come on. You went to Fiera, and then you went to Wisdom Tree. You helped bring their products to Canada.
I'll give you kind of an abbreviated version of it. My first job in this industry was, and I realized that I wanted to be in this industry after I finished university. and I was traveling, and I took my Canadian securities textbook with me on my trip, where I was backpacking through South America and Asia for almost a year. And this was 1994. And if you recall, the economy wasn't great in 94. So I couldn't find a job in the industry. So my first job was I became a telemarketer for a group of financial advisors to help them get people to show up to financial planning seminars.
Right.
And then I was doing really well, bringing in a lot of people. And then these advisors that I was working with asked me if I'd be interested in helping them manage part of their book. And so I said, sure, that's a great opportunity. And I did. And then we went through the Quebec referendum, and the markets went haywire, of course, as many
Yep.
of your viewers will remember. And I realized that, I'm 23 years old. I really don't know enough to be managing people's life savings. So I gave my book to another advisor that worked in the office. And then I helped. I got connected to a guy that was setting up Excel funds, which was kind of an emerging market mutual fund business. So I went in to actually help him build it out. I was the number 2 guy there. And that's where I got my education on how to build product and how to distribute. And then after about 5 years, I decided I wanted to do my own thing. And you mentioned it before. I went and built a hedge fund business that turned out to be fairly lucrative, and sold that business to Jovian. Jovian, a lot of people may not know too much about Jovian Capital, but they're a mid-sized financial services firm. They ran about 13, 14 billion. Later on, were sold to Industrial Alliance. But what I did there is built out the entire asset management platform for them, built it up to about 5 billion in less than 5 years. And then in 2008, I decided I wanted to go do my own thing again, but it was also going to coincide with the birth of my daughters, because I have twin daughters. And I thought, this will be great. I'm going to take, 6 months off and be a dad to my newborns. And then I'm going to work on building my next business. Little did I know that the end of 2008 was going to be a complete disaster in the market. So I took a little bit longer to build that business out. And then I started a structured products company, and we got to about $1 billion. And then I sold that business to Fiera, and I went to run the retail business for them. And then after Fiera, I went to run Canada for Wisdom Tree, which is one of one of the world's largest ETF providers, and got the itch again to build my own business. And realized that, and I will absolutely say this is the last business that I'm going to build. This one is it. And what's been great about putting this business together is there's always got to be some advantages of getting older in the business. One of the advantages is when you go through different companies and you progress in your career, you get to meet a lot of great people. More importantly, you get to work with a lot of great people. So I call Evolve kind of our greatest hits, because almost everybody that's with me has worked with me in a previous life at another firm. So I'm able to actually pick and choose who are the best people that I work well with, that I can trust, that are really great at doing their job. And so I'm a huge believer in the fact that the genius isn't in the idea, it's in the execution. Right. And I think that I've been able to put together a team of some of the best executors in the business. And so here we are today with Evolve. We're 2.5 years in. It's been great so far. Obviously, the markets in some periods have been challenging, but it's taken a lot of pride in the kind of products that we've put together. And like I said, the team that we've built as well has been pretty fantastic.
Well, listen, I've always been very impressed with what you've done, especially as a guy who doesn't think you can tie your shoes half the time. So you've done really well for someone that I don't think is very bright. So
well, these days we're wearing flip-flops.
Well, we are now because it's summertime and we're all working from home.
That's right.
So
that's right.
Well, let's get into a little bit of some of the funds that you've created, right? Because I think you've created a lineup. Like, there's lots of plain vanilla style investments out there. There's a lot of Me Too, like we have it. It's all copycat stuff. But you guys have created some really interesting things that we don't really see anywhere else. So, like, for example, I'll go through a list of some of the ones that jump off the page to me. So cybersecurity, you've done an ETF that's targeting that theme. E-gaming's another one, which is the hero hat you're wearing that you're going to send me one of those hats because I think it's fantastic.
Yep.
I want one of those. Automobile innovation, which we can talk a bit about. Global healthcare is one that I know you're advertising those right now on BNN, Bloomberg, and some other places. That's really got a lot of investor attention. The other one that we'll get into, well, before I keep going, I think let's just stop with some of those, because what's interesting is you've always been a guy that's tried to pay attention to what investors are looking for or what problems advisors are trying to solve. So how did you wind up with this being the kind of suite of stuff? Like, what was it that drove you to say that's an area we want to exploit? And then I'm curious about how that's been turning out with fund flows and what people are actually buying. So start with any one of those that you want.
Yeah, and I think it would be good to kind of go 30,000 foot for a moment, because also important to, I think, explain why I decided I wanted to get into the ETF business in general. And for me, a lot of the businesses that I had been involved in the past and the products that we had, they were well designed, but the unfortunate part about a lot of them was that the investors oftentimes, because of the fees involved and so on and so forth, the investors were the last party to actually earn a decent return on their portfolio or their placements of capital into the fund, and everybody else was profitable or making money off of them. And so the pyramid was inverted. Because ultimately, if it's your investors' money, then they should be entitled to make the lion's share of the profit tied to their investment, right? I mean, it's a pretty simple concept. Unfortunately, in the past, a number of funds and structures and products were not catered to that. So, to put the pyramid back on the right side, and to move it back to inversion, it was really important to get involved in product, especially as investors are becoming more sophisticated. Advisors are obviously more sophisticated, giving them products that gives them access to different markets and different strategies, but enables them to make the lion's share of the return. And so that's the reason why I'm a huge believer in ETFs, because ETFs are completely aligned with investors' best interest. So the next part for me was to figure out, okay, I know I want to build out an ETF business, and I had obviously, been involved in other ETF businesses in the past. What am I going to build out here? Well, I don't think, and I'll speak from like 3 years ago when we were starting to put Evolve together, I don't think Canada needed another TSX 60 ETF or another Dow 30 ETF. I think that the big issuers, the iShares and the Vanguards and BMOs of the world, have those very well covered. And why would anybody buy Evolves versus buying those? Where I saw a big opportunity in the space was kind of in two areas. One, I'm a huge believer that in certain asset classes, active management can make a big difference on a risk-adjusted return basis. I would argue that almost anything to do with fixed income, for example, benefits from good active management. You could make the argument that maybe you don't need active management for a Canadian large cap portfolio or a US large cap portfolio. Maybe you're just better off by opting for cheap beta or a cheap passive ETF. But there's other areas of the market, and not just in fixed income, but when you look at other areas like infrastructure, you look at areas such as emerging markets, you can point to a good manager can make a big difference on a risk-adjusted return basis. So for me, it was identifying those asset classes. And then the next step for me that differentiates us a little bit is we're not going to manage that asset class in-house. We are going to go out there and try to identify who is a best-in-class manager for that specific asset class, who has a great track record in that space, and maybe even a great brand as well. So most of our competitors tend to internalize portfolio management. We tend to externalize it because our view is that while it also means that we have to share a portion of our revenue with an external party, hopefully we're building better quality product by partnering up with a manager that has a strong track record. So we've partnered up with Allianz Global Investors, who are the sister company to PIMCO. so very well versed in fixed income. We've also partnered up with a great local manager here in Canada called Addenda Capital. They've been often called the PIMCO of the North. They run about 30 billion in assets as well. They're actually owned by the Cooperators Insurance. So we brought a couple of really good managers. Where we've gotten a lot of attention for our business has been more so around our thematic, which you brought up. Our thematic, primarily index-based ETFs. And the purpose for putting those products together was to allow investors to express a view on a specific sector or subsector.
Right.
And capitalize on it. So these are really growth-oriented strategies for investors, but now allowing them to capitalize on that segment of the market. But really importantly for us, we wanted to make sure as we were putting these products together that these are not just fads or flash in the pan ideas, that there's a solid long-term investment thesis attached to each of these. And then what we also do is we'll stress test. We'll take a look at some of these sectors and say, how would this sector perform in a recessionary environment, which, as we all know, we are now embarking on at the moment. So how will a sector like this perform in a recessionary environment? That's really important to us. The other thing that's really important to us as we're designing these products is, what are they providing investors? Okay, great, they're providing growth to investors, but we also want to make sure that they're non-duplicative to what investors already own. Meaning, if you have the S&P 500, you probably have about 20 to 22% exposure to technology. Most of that's probably tied to the FANG stocks, the Facebook, Apple, Amazon, Netflix, Google, right?
Exactly. Right.
You probably don't need more exposure to the big technology behemoths. And you could also argue that a lot of the growth has probably been had in those types of companies as well. So you brought up e-gaming, great example, right? So Google owns Stadia, which is their gaming division. Amazon owns Twitch, which is their gaming channel, online channel as it relates to gaming. Those are not stocks that are going to be in our e-gaming ETF, because the view is two things. Number one, you probably already have exposure to the Amazons and Googles. And number two, gaming for them is a very small portion of their overall revenue. So it really shouldn't be part of an e-gaming ETF. It really should be there within your broader investments. What we really want to give you in our funds is pure exposure to that specific subsector. So you would have in that fund, as an example, you would have Nintendo in there. You would have Electronic Arts or EA as well. You would have Activision Blizzard, because those are companies that are effectively close to 100% of their entire revenue is tied to e-gaming and esports. So that's one example. So you mentioned some of our products, and we launched Canada's first cybersecurity ETF. It is definitely one of my favorite products. The long-term thesis, investment thesis behind it is incredible. We launched Canada's first future of the automobile ETF, kind of tied to the whole concept of autonomous, connected, electric, shared. We launched Canada's first innovation fund. We launched Canada's first e-gaming fund. So a lot of firsts that enable investors to express views. And what's been great is that the performance, ultimately, we talked about that at the beginning, which is you build these products to with the intention that they're going to pay a lion's share of the performance to the investor, and that's what's ended up happening. Like our cybersecurity fund's a great example. It ended up actually being the top performing equity ETF in Canada for 2018, out of over 500 equity funds. So no small feat for it. But what's great, and you and I have been doing this for a long time. You and I both know that, usually speaking, last year's top performer is this year's bottom performer, right?
Right.
It's always kind of been Murphy's Law. Well, what's been great about that fund is that we're now 2.5 years old. Not only was it the top performing fund in 2018, but it's the number 2 performing equity fund since we started it 2.5 years ago. So it's actually consistently performed really well. So I mean, that's done well. Our healthcare fund has been the top performing healthcare fund in Canada, ETF in Canada, for every time period. So we've been blessed with some great performance. And obviously, we've been pretty thoughtful about how we've constructed the products.
Well, yeah, and I think what you mentioned a few minutes ago is very important. It's not just a fad, right? Like we've seen, these are themes that are not going to turn around. And like the cybersecurity one, like all of us now are having to work from home, and the degree to which we have to protect data and protect it on laptops. Like we're not just sitting in, our offices with everything locked down. It's all wireless. So you're right. This is, I think the performance of that can continue. It'll be bumpy at some point, but certainly we're not using less, we're using more. And same with healthcare, with this pandemic, there's so much money flowing into that category. So you created something unique for us to exploit. And I come back to, the fact that you keep making things that fix a problem for us as advisors. How do we exploit this theme? And I think the way of using an ETF to exploit the theme is better than trying to pick the individual securities. I remember seeing a presentation, this is like 15 years ago, that showed all the major computing stocks that existed on the day that Microsoft went public in like 1986. And you had said back then, I think this personal computer thing, I think it's got some legs to it. I think this might be a good idea. If you'd gone out and bought the top 19 biggest computing companies at the time, and you made sure that you also put this little new business called Microsoft in there, what would you have had going on 10 or 15 years later? And what was amazing is that the only stock that actually survived was Microsoft, because you would have wound up with a portfolio of digital equipment, Burroughs, Compaq, Wang. Anyone that's watching this is 25 years old goes, I don't know what he just said.
Yeah,
like all
there's
these
a
companies
reason.
are gone. Yeah, so something I learned a long time ago as an investor is you can have the idea right, but you can get the stocks wrong. Like you could easily get the theme, but you pick the wrong business. So I think what's better for us as investors is to say, look, we want to figure out what themes make sense, and then just align to someone that's going to buy us a basket to get it mostly right. Not exactly right, but also not really wrong. But then if we can also get, as you've done, find smart people to help make that basket selection great. Because I don't know. I barely got this thing working today as we've been talking on this GoToMeeting thing. So clearly we're not equipped to do it, but there are people who are. And that active management conversation earlier, that's been an interesting schism in our industry for the last bunch of years. And it's funny how the press sometimes zeroes in on it, that ETFs are good, funds are bad. And that's not really the point. The point is there are places in the market that are so efficient, there's not really any point in doing your homework. If you want to allocate to the top 15 dividend paying companies in Canada, like there's not much benefit of telling apart Royal Bank from CIBC and they're just buy them all, right? But there are certainly places like in e-gaming and in foreign markets where, doing your homework, there's a big difference between the people that did it well and those who didn't do it, right? And so capturing that active component, I think, is really good. And you're right, you guys do. I've zeroed in on some of the thematic things like the press does, because that's what gets them attention. But you guys have built out a pretty good platform of other things too that we can use. I want to move now to another problem you solved that might not be very sexy for investors, but for us as advisors and portfolio managers, it actually solves a really key problem, which is how do we allocate and hold cash for clients at certain times? So just to take clients through this for a second. So one of the big innovations from a decade or so ago was we used to just let cash sit in an account and you got paid an interest rate on it, and then interest rates went to nothing and no one paid you on it. And then most of the banks in Canada started to create these high interest savings accounts. So TD would have one, Royal would have one, CIBC would have one, Home Trust would have one. So it allowed us to get a bank account with CDIC protection and get a better interest rate on it for people. The challenge, so that was great that we now had a way to manage cash for folks. But then the next problem was now we've got 8 or 10 or 15 high interest savings accounts to juggle around, and we're not really making much money. So this became a lot of effort. So that was another problem that investors and advisors kind of had. Now you've actually fixed that problem for me too. So this might be kind of dull for people, but actually it's very important. So would you mind taking us through the HISA, H-I-S-A, or high interest savings account ETF that you just created, please?
Yeah, it's absolutely. I mean, there's a lot of cash, and I think, investors have two forms of cash needs: longer term and shorter term. And so oftentimes the longer term, they might want to buy or invest in a 3-year GIC or term deposits and things like that. But for the shorter term cash, and the shorter term cash is maybe there to make sure that, you've got enough to sustain your lifestyle, or you want to take advantage of different opportunities in the market where you want to have some cash on the sidelines and then redeploy it as well. That's really where HISA, that's the ticker for the ETF. That's really where HISA can come in. So you're absolutely right. We went to the banks and we were able to negotiate a premium rate of 0.5% above the overnight rate. Now, everybody knows a couple months ago, the overnight rate was 1.75%. Today it's 0.25%. So the overnight rate has obviously come down quite a bit, but we have maintained our premium above the overnight rate of 50 basis points or 0.5%. So basically what these are is the proceeds for the fund are retail deposits with in our case, four of the big six banks. So four, obviously, Schedule 1 banks. So effectively, from a risk perspective, the investor's risk is tied to the solvency of those banks. And I often say to people that if you're worried about one of the big Canadian banks becoming insolvent, we are probably going to have way bigger problems to deal with.
It's zombie apocalypse time at that point.
Yeah, it's zombie apocalypse time, exactly at that time. So it's a pretty safe investment. It provides investors with daily liquidity, so there's no lock-in or extra fees or anything like that. I mean, you got to be really careful about some of the gimmicky. I shouldn't say gimmicky. Some of the fine print in GICs that you see today, in terms of 1-year GICs that might have a great headline number of like 1%, which today is great, 1%. But then, it says something like, if you redeem within the first 90 days, you get 0 interest or no interest paid in the first 60 days and things like that. There's a lot of there's a lot of fine print in a lot of these products that you just got to be careful of. Ours is very simple and straightforward, and just fills a need for investors. And truthfully, I don't really understand why investors use money market mutual funds because they would arguably have more risk than a HISA product, because you've got short dated debt investments in there. And most times they're actually yielding significantly less than our HISA ETF as well. And they have more fees attached to them. So to me, when I look at the opportunity for this product, I think a lot of it lies in the ability for investors to process the risk reward payoff for their money market mutual fund versus this HISA ETF or fund version, because we have two classes of the fund. We have a mutual fund class as well as an ETF class for it. So it's a great product, and we launched it in, I think, end of November. And we're about 250 million in assets in that fund, so it's had some pretty good growth.
Well, yeah, and it's a product of its time, right? Like the money market fund came out 40 something years ago, when if you left your money on deposit with the investment firm, they paid you a very nominal rate. So the money market fund was created to give people a better solution, right? But that we've all outgrown that, because now the high interest savings account, gives better flexibility, better safety, no cost, and a better yield, and easier to use. So it replaced the money market. But a lot of people just left it sitting in money market because they're not paying attention. And I think you've now created the next evolution of the HISA account. So and from our
complacency, I was going to say complacency sometimes can be a real big issue, right?
Yeah.
For investors, oftentimes, where they just get comfortable in a certain place, and oftentimes they don't necessarily want to look at something that's far better than what they're already invested in, so they just stay there. I mean, we all have complacency in different elements of our life for sure, but I notice in a lot of portfolios for investors, they just tend to stick with what they feel comfortable with, not exploring other opportunities.
Well, and we see that when new clients come to us, right? And I look at their portfolio and it looks like the junk drawer of my kitchen. Like just went in there and I forgot about it. But from our perspective, what the HISA is going to be able to do, in particular, and for clients, instead of having 3 or 5 or 7 different line items kind of polluting the statement with different, we got the TD, one of the Royal, we can just go, no, we're just going to replace it with one. It's much more efficient. Yep. We don't have to worry about chasing a yield or chasing a rate. Because this is the other thing I don't think people understand is that, in the old days when people were comparing GIC rates and getting in their car and driving from bank to bank to bank, and comparing rates, what would happen sometimes, and we see this even now, is if you have to move the money from one institution to another and it takes a day or two, well, that delay just costs you whatever the additional rate was. So, and now that interest rates are approaching like atomic level, you can't have a delay. Any delay to chase a better rate just costs you whatever that differential was. So you think you won, but you actually lost, right? So you made that much more efficient. So we're going to start rolling that out pretty quickly because we were able to get that product approved at Raymond James very recently.
Yes, thank you very much. You were the point person in helping us get that product approved at Raymond James. So that was fantastic. 20 years.
A big shot, right? No. I made it. Listen, just so clients know too, we don't approve everything that comes along. We've got a very thorough product approval team that looks at every product that goes on our shelf, and which sometimes is annoying because they do look under the hood and they take it for a walk and they double check everything. So only products that meet certain standards can be on our platform for clients to access, which is true. But they do often need someone to advocate it to get it through to run it through the gauntlet. So I was happy to champion this product because it was one that, from our perspective, solved a really good problem. It was also interesting because I got to look under the hood a little bit more than most advisors would. And I had to actually explain a couple of things to our product approval committee because they had a few assumptions and things. And so it gave us probably a closer glance at how you construct it than most people will ever see. So thanks for kind of opening up the kitchen and letting me poke around a bit. Which I would do anyway because I'm your friend and you're going to damn well let me do whatever I want, right? Raj, you know what? I'm going to close it there. Thank you very much for your time. Thank you for your friendship. I know I get to tease you, but I do adore you.
Thank you for yours.
And one day I'll take you to bingo because you're probably good luck.
I appreciate it.
Run with that, so. I appreciate it. And on behalf of all the clients, thank you very much. And I wish I jumped on some of the things at the beginning when you told me to, but I'm pretty stupid, so it takes me a while.
It's never too late. It's always long term.
Never too late. So it's never too late. But anyway, thank you very much. Stay safe, say hi to the family, and I'll talk to you soon, buddy. Take care.
To you as well. Thanks, Darren. Take care.